This video is brought to you by the Concrete Pumping Association of Australia. For more information, please visit our website or give us a call today.
Good afternoon and welcome to the Concrete Pumping Association webinar series for 2020. My name's Craig Hardrick. I'm the Chief Executive for the Concrete Pumping Association. This, as a part of a whole series of webinars, are actually posted on our website from time to time, and I'd really encourage you to consider sharing that link with other people. So what's the purpose of today? Government incentives and a bit of a tech talk around finance related matters. We're kind of having a bit of a chat here offline about why the association will be running something, and I suppose the essence of it was it came out of a series of conversations we had with some manufacturers and some members, and they seem to be issues at two polar ends of the current investment cycle. One particular member was talking about a series of pumps which were going to be sold very soon, and the finance had fallen through on those deals, and they found there was a significant tightening of the belt occurring. Conversely, I had a couple of members based in Melbourne that were talking about they recently bought some new gear and had no issues raising finance. So there seemed to be a bit of confusion about what were the COVID affected sort of finance environment. I think second to that was there were significant incentives that were coming out from the government, which were potentially something that could be taken advantage of. So we thought we'd reach out to one of our members in Michael Ryan, Senior Partner from Equipment Finance at Finlance, and essentially invite him to give us a bit of a heads up on what the current landscape is and what are the opportunities. And Michael's put together a very interesting and fascinating presentation to sort of talk about some of the options out there. As I said, we do have a series of webinars, so I encourage you to go to the website and check that out. I don't want to take up too much time, but the one thing I do just want to share with you is that during the webinar, if you've got any questions, you don't need to save them to the end. You can actually go into the little panel on the right-hand side, find the Q&A area, and type in your questions and submit them. And what we'll do is we'll save them to the back end. Okay, so look, without any further ado, I'm going to switch out chairs and get Michael to sit here.
Thanks very much, Craig. Welcome along to this seminar. And like Craig said, my name is Michael Ryan. I'm from Finlance as a senior partner broker there. Our business has been running for 30 years, helping businesses like concrete pumpers and other civil industries, manufacturing, transport, and a whole range of capital intensive businesses get access to money across a whole range of lenders that we work with. And like Craig said, I had a conversation with these guys, and what was really interesting was that obviously to be successful in your business, you've got to do a lot of things right. And as part of that is how you run your financial affairs. And for us, we represent your business to get financed. So it's always good to make sure that you're up to date with all your financial reporting, getting that information together to someone who can then actually represent what you need well into that financial institution and understand what the equipment is and how it's been done. So when he talks about two polar ends, you've got to make sure that the way you present the story is done as best as possible and you have the right people doing that for you. In particular, the topic that came up is government incentives, and one that's very dear to us is the incentive around the write-off for purchasing used and new, used I emphasise in brackets, only till the 30th of June this year, and then through to the 30th of June 2021 for new assets only. So what I'll do is I'll run through this slideshow. It's a little bit numeric, but it's got some very positive outcomes for those that are willing to take the opportunity to invest in their business now up until 30 June 2021. Although a lot of people might be more focused right now in running their business day to day with all the other concerns going on around COVID-19. So this incentive is around for quite a while. It's not something you have to jump onto immediately. So in that sense, it's just more about being aware, and hopefully some of this information will shed some light on it and help your decision process a bit easier down the track. So if I go on to our next slide here. there are two parts to this package. Okay, the first part is assets that are under $150,000, and then there are another part which is greater than 150,000. Package one. Okay, so anyone's eligible in terms of the asset type. So we've got vehicles, we've got equipment, we've got machinery, trucks, trailers, anything to do that's a capital asset intensive type of equipment. The purchase price needs to be less than, excluding GST, less than $150,000. And that's effective from March 12, any assets bought from March 12, when the federal government made the announcement on this package, up until the 30th of June 2020. The asset in this case can be new or used, including private sales. So it doesn't have to be directly from an actual supplier as such. Each asset, so you can have multiple of assets ranging from a truck, a pump, a utility. So it covers a whole range of multiple assets, not just a one-off thing. So you've got that benefit of multiple assets available to you. There's no limit, like I was just saying, so that's nice and easy. The assets can be purchased outright. So if you've got good cash flow or you've got retained earnings that you don't need to borrow money, you can do that. But it's really important that when you do finance, that you understand leasing as a finance product doesn't work in this case because the bank technically owns the asset. So you need to do either a chattel mortgage as a product or a commercial hire purchase. They pass on the ownership benefits and the depreciation and the interest component being claimed as your tax break. This initiative is only available, as I said, up to the 30th of June for new and used items up to 150. And this is an instant write-off for this category. And I'll show you an example of what that means from a tax point of view, as you see in the slides as they come through. So if we look at the first example, assume we've got ABC Pumping acquires a new truck or a used truck for that matter in this category. And in this case, we've picked $140,000 excluding GST as the amount we're going to work through this example with. No need to depreciate the asset in the year of acquisition. Typically, an accountant would apply 15% in the period that it's acquired up to the 30th of June, or that period that the asset relates to. Wouldn't matter if you owned it one day, you still get 15%. That's the traditional way it works. Thereafter, it's 30%. So as the written down balance is done on the accounts, the following year it's written down at 30% and so on over the effective life of that asset. But because we've got an asset under this stimulus package, the whole lot's written out in the first go when the accountant completes the financials for the period. So if we look at that from a numbers perspective, assume ABC Pumping generates a profit of $200,000 this financial year. That means that you then have to pay tax on net profit. And if we assume the company tax rate currently is 27.5%, it will equate to tax payable of $55,000 for that business. Sure, we have PAYG for companies like we do with individuals as you go, and that's based on your prior year's profit, as well as each time you lodge your BAS statement, there can be adjustments done by the accountant to suit the situation. But effectively, that's the tax you either paid along the way or you'll have to pay if you pay it one lump sum. So if we look at the 100% write-off, we then adjust our profit. So $200,000 less our 100% write-off of $140,000 that we paid for the truck, now has an adjusted net profit of $60,000. We then apply our company tax rate of 27.5% on that figure, and we now have a tax payable of only $16,500 versus $55,000 had we not made this investment. So what does that mean? That means we're actually getting a tax benefit. We're not having to pay as much tax because we've increased our tax deductibility, and therefore we have a $38,500 tax bill saving by doing this investment. Of course, there's the upside to the truck as well. It could be great in the business, and that's the reason why you did it. It could have been one that needed replacement and it had a lot of mechanical breakdowns and was costing money. So the upside is not just saving tax or reducing your tax obligation, but the efficiencies you gain also from that investment. Of course, there's interest if you are borrowing money, which I can talk about, well, we'll talk about a little bit later. You also get the interest component as a deduction in the tax period as well. Package 2, this is where we talk about 50% instant tax write-off. So we've got 100% write-off in the first instance, only available up until 30 June this year. And then we have the second package, 50% immediate tax write-off anywhere between now and 30 June 21. And the reason why I say now is if it is greater than 150,000. But the key in this is that it has to be new when it's over 150,000, okay, up to 30 June, because we've got the use component sitting there. There's no limit. Again, same basis. You can have a number of assets that cost more than 150,000, and you can get this benefit on each item. Assets can be purchased outright again, or using finance. And I must remind you that do not use finance lease, as you won't get the tax benefit. It should not recognise as the owner. The initiative is available for 15 months, like we said, up until 30 June 21, and it's actually extended as an initiative and will be applicable to assets that are actually less than 150,000. So once we pass 30 June 20, there's no limit as to the dollar value for the 50% write-off. You will get 50% plus 15%, which I'll show you in the next worked example that's coming up. So in example 2, ABC Pumping is now purchasing a new truck and pump for 600,000, excluding GST. So as the asset cost is greater than 150,000, you can immediately write off the 50%, like we just talked about. Plus, you will gain a further 15% on the written down value in the first year. So earlier I mentioned that traditionally you were claiming 15% purely in the first year of purchase. What they're saying in this package is that you'll still get that, plus you'll get the 50%. So you'll see as the worked example comes up how that's going to work. So if we look at 50% of the purchase price, it gives us an instant depreciation of 300,000. And coincidentally, because it's 50%, our written down value on our books now is 300,000. So when we take into account the additional benefit, normal 15%, we now have an additional $45,000 worth of depreciation that's becomes deductible, giving a new written down value on that brand new truck and pump to a written down value of 255,000. So we're gaining a tax break of 345,000, which is A, 300,000, and B, 45,000. So that's going to come off as a deduction to your bottom line. So if we go back to the equation, well, if I did nothing, and in this particular circumstance, ABC Pumping has a profit of 350,000. Once we take into account this deduction, we're going to see the following benefits flow. So the tax payable on 350,000 at 27.5% is $96,250 payable to the ATO. But you little beauty, along comes our tax break from this stimulus package, and we're going to adjust our net profit now by our deductibility of 340,000, and now we've only got a adjusted net profit of $5,000. What that does is creates a tax bill of only $1,375 that's payable to the ATO versus what we had with no investment at $96,250 that would have been payable had we not done this investment. So we've effectively achieved a saving of $94,875 through this investment, and we get the interest too. The written down balance, 255,000, then goes on to be depreciated at the normal rate of 30% diminishing value each year over the remaining effective life of that asset. So year 2, the deduction becomes a $76,500 depreciation deduction on your expenses for your profit and loss, which in its own sense is an additional $21,037.50 as a tax saving, because it's coming off your bottom line, which you're not paying the corporate tax rate at. So it then starts to slowly go down as the written down value comes into play. So year 3, you see with the drip what actually is happening. So the new written down value becomes 178,000, and our tax benefit now flows down to about 14,000 odd dollars, which is the normal process how the whole depreciation cycle works on capital assets. Okay, so just a reminder, the 50% is effective now up until the 30th of June for over 150,000. Okay, so but if it is over 150,000, it's for new asset only. If it's under 150, it's new or used, and it's 100% write-off in that case. So when we talked about the interest component previously, I ran some quick numbers on the 140,000 with the GST financed over 60 months with a 25% balloon, and that payment worked out to be $2,280 a month. When we multiply that out, we give a total repayment to be repaid of $171,000, $824.90, and we subtract that from our purchase price of $154,000, and that's $17,824.90 in interest, which we divide over 5 years, the term, to work out our average interest, although it's P&I, more interest in the first year, a little bit less in the second year. Principal component and the reduction of the loan goes up as the interest component comes down. But for simple purposes, and a lot of accountants just average it over the term, it's $3,564.98 per annum as interest, which gets added into the other expenses in running the business. And at the company tax rate, it's a further saving of $980 odd in benefit from the interest component. From the pump side, we're looking at financing the amount including GST of 660,000. Same structure, 5 years with a 25% balloon. Our payments are slightly under 10,000 at $9,773.21. That equates to a total repayment of $736,392. Interest sounds a lot, but it's all relative to the amount that you're borrowing. So the interest in this case is $76,392, and over 5 years, it's only a merely $15,278. Again, it all needs to be relative to what that pump is doing for you in generating revenue, or giving you greater access to sites because of your booms are different sizes to suit the site and those aspects of the whole idea of the pump naturally. So what that works out is purely an additional tax saving of $4,201 on that per year as extra tax advantage to your business. The GST, it's one of those things, it's a personal thing more than any, or a cash flow as well from a business perspective, but if you've got it, sure, pay it up front, get your input tax credit, finance the net amount. But one thing that's quite interesting for smaller to medium-sized businesses that even though the GST comes back into your business, whether you pay it up front to the supplier or you finance it, you get it back either way. But interestingly, the GST really equates to 6 months worth of payments without outlaying any cash flow within your business. And the rates today on equipment finance is super, super low. You know, you're getting rates in your 3% ranges, and overdrafts are still like 8%. So businesses are financing out of overdrafts to pay the GST and then, you know, putting the credit back in or not, and using that credit for other future tax obligations. The equipment finance interest rate is so much cheaper, so therefore better management of your cash flow in terms of making the most of what you've got. And what in effect it does do is it gives you 6 months worth of instalments without any outlay and extra costs. So if you've got any teething problems, or you're new to the game and you need that bit of breathing space, financing the GST is a good way to go about it. In terms of banks and the other end of the polar, like Craig was talking. There is an appetite. They have been swamped with massive requests to defer loans, both from a personal level, home loans, personal loans, and business loans. You would have heard various CEOs talking on news stations around astronomical numbers of deferrals. There's upon hundreds of thousands of home loans have been deferred. Quite a lot of businesses have deferred loans. But at the end of the day, the appetite is there. There are certainly more questions that are being asked than what people are used to. And I guess in some ways it's back to the old days of lending, maybe 20 odd years ago, where this type of lending style has always been there, but for other reasons it hasn't been employed as much as it used to. But the appetite's there. Our success rate from our business is still fairly high. But most important thing I can recommend is that don't put your loans in deferral unless you truly do need to. There's and it's not to say that it's not taking on your accountant's advice or your own peace of mind and saving that money for a rainy day. But if you do have a need to borrow within the next 6 to 12 months, we're currently experiencing that anyone has put loans into deferrals. It gives the bank a very good reason to say no to any future requirements between now and say even a 9-month to 12-month kind of window, because that puts doubt in their mind, because you've put it there in the sense that if you can't afford to make your payments now, it's not a good case going forward to justify why you need to borrow more money on something. And normally these capital loans for pumps, trucks, vehicles, utes, those sort of things, are usually because the business is producing income from those assets, or they're replacing other worn out assets. So if there's a concern about future cash flow and you're in deferral, chances are you'll get a no, unless it's an extremely good reason, like one asset was written off and this was replacing another asset. So just be very careful of that, please. And also be aware of COVID-19 questions that you may be prompted from your bank manager or from someone like myself as a broker trying to help. We're now obligated to ask you if you're actually affected by COVID-19 within the business, so income dropping, jobs not continuing because of site access, things around new projects that you had won but had been delayed. So they're the type of questions we're getting that affect the business immediately. Then we're getting a second question that's asked around, if you're not directly affected, what about your other suppliers to your business, the people basically that are paying you to perform the work? Are they affected? That would stop the cash flow to you. So that's most of those issues we're dealing with quite well. So unless you're front line and badly affected, it's very difficult to get finance. But we're finding that anyone doing the civil side, we've got good infrastructure projects going ahead. So we're going through the yeses with banks quite easily. It's always good to have your accounts up to date. I know a lot of businesses do quarterly BAS statements, but they're not actually doing the financial part of it, the balance sheet and the profit and loss statement. It's pretty easy for accountants to knock those out when they do BASs. So it's always good to keep that up to date, or if you know you do need to borrow, they are asking for the latest set of information. And in some instances, we're having to provide the last 3 months bank statements to show the income coming into the business and the outflows going out, and what's left over by way of those bank statements. So if you do get those questions asked, don't take it personally. It's just the way they're having to lend now to be sure that the impact of COVID flowing through is not going to increase risk to the banks lending in an environment where they've got billions upon billions of dollars in hold at the moment, on the pretense that people will be able to repay that when the repayment period restarts in 6 months' time. And again, it comes back under their responsible lending that they're required to do by their APRA, which is the supervising body, and also the Reserve Bank, the RBA. So it's just treat it as a question, answer it as best as you can, and you should be fine. And also, I've got their tax portals. It's just like a bank statement, but it's with the tax office. It shows when you lodge your BAS activity statement, it shows your regular payments monthly, quarterly, when your GST is due, it shows all those payments being made, and if there's an outstanding balance because you're behind or if you're under a payment arrangement. So because these the equipment that you all work with are quite expensive in dollar terms, usually anything over $250,000, we're seeing the request to produce tax portals to show that businesses are up to date with their tax obligations. And that comes back down to, again, just good cash flow management, making sure you're on top of all your expenses, and more than anything, showing to a lender that you are worthy of more money. Interest rates remain low, but there has been some talk that because there has been a bit of an increased risk in the economy to businesses falling over or defaults on loans, that as an investor, where they source their funds from, there might be an expectation for a bit of a better return than what they've been getting because interest rates have been super low. So when risk goes up, the price goes up. So as some of the lenders I've been talking to are sort of saying, oh, look, we've had a bit of a spike, a couple of points here and a couple of points there because of the risk that's been now factored into pricing going forward. So if we do see a little turn, that's the reason, because the risk in the economy has changed to where it was 2 months ago. That basically concludes the snapshot of the stimulus package around capital asset purchases on the 100% write-off and the 50%. And just a very quick snapshot. Yes, banks are open for business. Yes, people like me are doing a lot more work to get loans approved. And yes, it's like setting homework, that if you want to pass the test, you've got to do a bit of homework to get your information together so that the best outcome, the best rates can be delivered back to you. So of course, if there's any questions or answers, I'll give the answers as best I can.
I'll let you stand there.
Yep.
Guys, thanks for joining us online. I'm not going to come into the camera shot, but we've got no questions during the discussion, so I can only assume that Michael has been very thorough in terms of addressing all the concerns. What we will be doing, as I mentioned, will be essentially providing this recording online. We're going to share it through social media so people can be aware. Please be mindful that there's a very time dimension related to this particular series of government incentives, and things are going to change as the government changes its policy on these things. So these do have a time dimension to them. So now's the time to probably act. I suppose if I could just ask you a question, Michael, to the camera, is that what's your general feel about the industry? Because you have a lot of people, obviously clients who are in that space. What's your general feeling about their level of confidence around business and investing and stuff like that? Have you got any sort of general guide for that?
I do think that the confidence in terms of clients' workflow is pretty positive. Okay. They're indicating to me they've got work that's 3, 6 and 9 months out. That's good. There's tenders that are out that have been sidelined temporarily.
Yeah.
And some of that's been, what would you say, has been reinvigorated by the likes of Gladys Berejiklian coming out and saying we're going to push our infrastructure projects ahead a lot quicker. So that's given a lot more confidence around that side of it. I think in this industry, from an infrastructure side, it's very positive. The outlooks is good. We also have a lot of exposure and do a lot of work in the mobile crane side.
Oh, okay.
And that side's very positive and moving quite well. Sure, the residential side is one of those things where it's a wait and see. There's a time lag of people's decisions now from deferring loans and whether they can recover from those. And if banks have to force sell those assets to recoup their money, what impact that'll have in the economy in supply terms and resale values. Yeah. You know, we've got always the buying off the plan when projects aren't complete at a predetermined price. Yeah. So valuations at this stage, you know, there's lots of different talk from different people saying how they could be affected depending on the default rate. It's just an unknown at this stage on a private development side of work. However, you know, the added advantage is the government can turn up immigration, which requires more housing, or they can taper it off to try and recover from job losses. You know, they're talking about job losses of 10%. And if you've got immigration still flowing in, competing against the local people that are trying to find a job, then you create greater unemployment potentially.
Sure.
So they will play with those numbers to try and get the best outcome. One thing's for sure is that both the state and federal governments are very determined to have minimal impact on the economy as a whole. So I think that we're very fortunate that the government's got deep pockets to stimulate every way they can, and this industry is very infrastructure driven, so I think it should be okay. It's a case of you know, it's the highs and lows. It's a roller coaster ride for any business owner, and when it's you know, you're at the top of the cycle, you've just got to make sure you've got discipline around the working capital and that you do put it away for a rainy day, because we all know they come. This one certainly wasn't one that we would see coming, and that's not because of any other ones. Economic decisions. It's a health one. So it's a very unique situation in that sense, because it's never been experienced in the way that it's occurred. But it's, you know, just being sensible as a business owner. Doing the best you can.
Definitely one of those things. Rainy day was one of those things we learnt from the financial benchmarking work that we did late last year and presented the findings. And compared it with our international colleagues in the US. And as an industry, we tend to be a bit lean there. So that's an insightful comment. Look, Michael, I appreciate your time. I really do. As a member, I really do value your contribution and sharing your knowledge with the members. It's great. As I said, we will definitely be sharing this online and getting as much feedback as possible. And guys, stay posted for the next installment, I suppose, for the webinar series that we'll be doing to give you a bit of an update on how the industry is coping and the roads to recovery. Thank you so much, and have a wonderful afternoon.
This video is brought to you by the Concrete Pumping Association of Australia. For more information, please visit our website or give us a call today.